Hi everyone, welcome back to the Investing Iguana, where we talk about all things money and finance. I'm your host, Iggy, and today we're going to discuss a very important topic: why every Singaporean should keep an emergency fund. What is an emergency fund, you ask? Well, it's not a stash of cash hidden under your mattress or in a biscuit tin. It's not money that you use to buy the latest iPhone or go on a shopping spree. And it's definitely not money that you invest in the stock market or crypto. An emergency fund is your cash savings for rainy days. It's meant for unexpected situations that require immediate cash, such as losing your job, getting sick or injured, or having to repair your car or home. It's money that you can access quickly and easily, without having to sell your assets, borrow from others, or incur high interest charges. An emergency fund is like a safety net that protects you from financial stress and hardship. It gives you peace of mind and confidence to handle any curveballs that life throws at you. It also helps you avoid going into debt or dipping into your long-term savings or investments. So how much emergency fund do you need? Well, there's no one-size-fits-all answer to this question. It depends on your personal situation, such as your income, expenses, lifestyle, and risk tolerance. But a general rule of thumb is to have at least 3 to 6 months of your living expenses saved up as an emergency fund. For example, if your monthly expenses are $2,000, then you should aim to have at least $6,000 to $12,000 in your emergency fund. This amount should cover your basic needs such as food, rent, utilities, transport, insurance, and debt payments. Of course, you can adjust this amount according to your own preferences and circumstances. Some factors that may affect how much emergency fund you need are: A. Your job security and income stability. If you have a stable job with a regular income, you may need less emergency fund than someone who is self-employed, freelancing, or working in a volatile industry. B. Your family situation and dependence. If you have a spouse, children, parents, or other relatives who rely on your income, you may need more emergency fund than someone who is single or has no dependents. C. Your health condition and insurance coverage. If you have a chronic illness or disability, or if you have inadequate health insurance, you may need more emergency fund than someone who is healthy and well insured. D. Your lifestyle and spending habits. If you have a frugal lifestyle and low expenses, you may need less emergency fund than someone who has a lavish lifestyle and high expenses. Bottom line is, you should have enough emergency fund to cover your essential expenses for at least 3 to 6 months without any income. This will give you enough time to find a new job, recover from an illness or injury, or deal with any other emergencies. Now that you know how much emergency fund you need, the next question is, where should you keep it? Well, the key criteria for choosing where to park your emergency fund are: 1. Low risk. You don't want to lose your emergency fund due to market fluctuations or scams. You want to preserve your capital and avoid any losses. 2. High liquidity. You want to be able to access your emergency fund quickly and easily when you need it. You don't want to face any penalties or delays when withdrawing your money. 3. Decent returns. You want to earn some interest on your emergency fund to keep up with inflation and grow your savings faster. With these criteria in mind, some of the best places to keep your emergency fund in Singapore are: first place, high-interest savings accounts. These are bank accounts that offer higher interest rates than regular savings accounts. Some examples are DBS Multiplier Account, OCBC 360 Account, UOB1 Account, and Standard Chartered Bonus $ver Account. These accounts typically require you to fulfill certain conditions such as crediting your salary, spending with a debit or credit card, investing or insuring with the same bank, or maintaining a minimum balance. The interest rates can range from 1% to 3% per annum, depending on how many conditions you meet and how much money you have in the account. These accounts are low risk, highly liquid, and offer decent returns for your emergency fund. Second place, Singapore Savings Bonds, SSBs. These are government-backed bonds that pay you interest every 6 months. The interest rate increases over time, from around 0.5% in the first year to around 2.5% in the 10th year. You can invest as little as $500 or up to $200,000 in SSBs. The best part is that you can redeem your SSBs anytime without any penalty or loss of interest. This means you can access your emergency fund whenever you need it, while earning some interest along the way. SSBs are low risk, highly liquid, and offer decent returns for your emergency fund. Third place, money market funds, MMFs. These are mutual funds that invest in short-term debt instruments such as treasury bills, commercial paper, and certificates of deposit. They aim to preserve your capital and provide a stable income. MMFs are considered low-risk investments as they have very low volatility and credit risk. However, they are not risk-free as they are still subject to market fluctuations and default risk. MMFs also have low liquidity, as you may need to wait for a few days before you can withdraw your money. The returns on MMFs are also low, as they are affected by the prevailing interest rates in the market. MMFs are low risk, low liquidity, and low return options for your emergency fund. So which option should you choose for your emergency fund? Well, it depends on your personal preference and risk appetite. You may also want to diversify your emergency fund across different options to balance out the risk, liquidity, and return factors. For example, you could keep 1 month of your living expenses in a high-interest savings account for easy access and moderate returns. Then you could keep another 2 months of your living expenses in SSBs for higher returns and flexible redemption. Finally, you could keep another 3 months of your living expenses in MMFs for lower risk and stable income. The bottom line is, you should keep your emergency fund in a place that suits your needs and goals, while ensuring that it is safe, accessible, and growing. Now some of you may be wondering, what is the opportunity cost of having an emergency fund? In other words, what are you missing out on by keeping your money in a low-risk, low-return option instead of investing it in a higher-risk, higher-return option? Well, the answer is, it depends on how you look at it. On one hand, yes, you are giving up some potential returns by not investing your emergency fund in the stock market or crypto market. For example, if you had invested $10,000 in Bitcoin at the start of 2020, it would have grown to over $40,000 by the end of 2020. That's a whopping 300% return in 1 year. On the other hand, no, you are not losing out on anything by having an emergency fund. In fact, you are gaining something by having an emergency fund, financial security, and peace of mind. You are protecting yourself from potential disasters that could wipe out your savings or put you in debt. You are also giving yourself more flexibility and options in case you want to switch careers, start a business, or pursue your passions. Think of your emergency fund as an insurance policy, not an investment. You are paying a small premium, the opportunity cost, to get a big benefit, the protection and peace of mind. And just like insurance, you hope you never have to use it, but you're glad you have it when you do. So how do you build your emergency fund? Well, there are many ways to do it, but here are some tips that might help you. A. Automate your savings. Set up a standing order or giro to transfer a fixed amount of money from your salary or income to your emergency fund every month. This way, you don't have to rely on your willpower or memory to save. You can also use apps or tools that help you save automatically, such as DBSDG Savings, OCBC Money in $ITS, or Sing Life account. B. Save your windfalls. Whenever you receive a bonus, a tax refund, a gift, or any other unexpected income, put it into your emergency fund. This will help you boost your savings without affecting your regular budget. C. Cut your expenses. Look for ways to reduce your spending and free up some cash for your emergency fund. For example, you can cancel unused subscriptions, switch to cheaper alternatives, cook at home instead of eating out, or sell unwanted items online. Every dollar counts. D. Earn extra income. If you have some spare time and skills, you can look for ways to earn extra money on the side. For example, you can do freelance work, start a blog or podcast, teach online courses, or sell your crafts or services online. You can then use this extra income to build your emergency fund faster. Building an emergency fund may seem daunting at first, but it's not impossible. With some planning, discipline, and creativity, you can achieve your savings goal and secure your financial future. That's all for today's video. I hope you learned something new and useful about emergency funds. If you did, please give this video a thumbs up and subscribe to my channel for more videos on money and finance. And don't forget to hit the bell icon so you don't miss any updates. Thank you for watching the Investing Iguana, and I'll see you in the next video. Stay safe and happy saving.